Hello everyone. Today we are going to be talking about sudden increase of mortgage refinancing activity. Compared to this week ending September 28th, number of mortgage application has gone up 11% compared to the previous week. Out of all the mortgage application, about 50% of all the application are for mortgage refinancing. So the mortgage refinancing has gone up 20% compared to the previous week, and it has gone up 175% compared to the last year this week. The mortgage application was very high, reached in July 2022. Since that, the mortgage application are coming down and reaching a psychological level, 30-year mortgages around 6%. So a lot of people are either buying new homes or started refinancing their mortgages. So in this particular video, we'll also talk about when it makes sense to refinance your mortgages and what are the other pros and cons and benefits of refinancing your home. And I have a spreadsheet to show you, to illustrate, depending on when you change your either term or the mortgage rates, how much you could be saving or shorten the mortgage payment period. Hope you like this video, and if you subscribe, I would. Now, in terms of mortgage refinancing, why would you like to refinance? What are the benefits of your refinancing? There are a couple of points. Say, for example, as a result of refinancing, you may be able to lower your monthly payment, because when you go for a refinancing, your interest rates of your new mortgage is going to be lower than the current mortgage that you are paying. So hopefully your monthly payments are going to be less if you compare like similar mortgage, like the length of the mortgage, say 30-year current mortgage to another like 30-year with the lower interest rates. Secondly, you should be able to reduce your overall interest payments, because the more higher the interest rates, you're going to be paying more on the capital, the interest payments. So if the interest rate goes down, you're going to be saving more on your interest payment. Secondly, since you're cutting your interest payments, your principal or your equity on the house is going to be increasing. So you'll be building equity faster. And secondly, you may be able to cut out the PMI, the personal mortgage insurance, which is about 1 point of the mortgages. So if you do not pay 20% of your down payment, the lender asks you to pay the PMI, personal mortgage insurance, PMI. So if you can, as a result of refinancing, if you could pay this 20% down payment, you can avoid the PMI insurance. And also then you can also change the type of the mortgage. So if you had like a ARM, adjustable rates mortgage, you can convert it to a fixed mortgage, 30-year fixed or 20-year fixed, or you can convert from your FHA, Federal Home Association mortgage, to a conventional mortgages. So there are different consideration, or you could benefit as a result of refinancing. Now, in terms of when you consider refinancing your mortgages, there are a couple of things you should consider. First of all, what is your finances in terms of mortgage payments? So just because mortgage rates are going to 6% doesn't mean that you have to refinance your mortgage. You should know your current mortgage rates. So please take a look at your monthly mortgage statements, and where it will be clearly explained the prevailing mortgage interest rates that you have been paying. So if it makes sense, if the current mortgage rates is coming down, say around 75 basis points or 1%, it might make sense for you to refinance your mortgage. Secondly, the other thing you should consider is when you refinance is the closing cost. Usually, when you do refinancing, about 2% to 6% of the total loan amount you have to spend for closing costs. That includes your title search, attorney cost, and other like the flood search, any other like closing cost. So when you refinance, you should understand when you're going to be breaking even on in your on your closing cost. So if you're spending a lot of money, say if you had a mortgage $400,000, it could cost you anything say from 2%, meaning $8,000, to 6% to $24,000. So for you to refinance, it should make sense that your break even when you, as a result of saving money for refinancing, you should be able to reaching that break even point, or you should have more than have the break even point, so that at least you should be saving more than $8,000. And this benefit basically like break even, it takes some time when you're going to be saving, you're going to be staying in the house, or how long you're going to be staying in that house before you sell it. You're going to get all these benefits or save. You're not going to happen rather immediately. You're going to be saving the money month by month by month. So if you're staying there for like 1 year, so you should figure out like what will be like the amount of saving you're going to be doing. Or if you're staying there for 5 years or 10 years, what kind of savings as a result of mortgage refinancing that you're going to be having. And if you're going to be breaking even in terms of those closing costs, only when it makes sense to go ahead and do the mortgage refinancing. In the spreadsheets, I'm trying to illustrate to you, say if you have a mortgage, current mortgage, say for example, principal amount of $450,000 in this column C, original amount, and you're paying 8% rates for say 30-year mortgage, which is 360 months. So your minimum payment, as per this calculator, I'll see you the link for this calculator. keepthrifty.com, they have this calculator. So current payment $3,301, and suppose you pay $3,500, you're paying $200 extra, and your current balance is 400,000. I've highlighted in yellow. You're going to be refinancing, and on the right side, this is your proposed refinancing. Say you are refinancing this $400,000. And you are currently the number of payments is remaining is 248, about 20 year of mortgages remaining. So there are two scenarios, say in this like column from 16 to 18, how much money you're going to be saving as a result of refinancing without paying any additional payments. And if you pay $200 a month additional payments, how much you're going to be saving on your total overall interest payments, and how much how much you're going to be speeding up your mortgage payments. So on the right side, here is your like the new refinanced amounts. Suppose you're refinancing this $400,000 from this yellow, I copied it over here, and your new refinanced rates are 6%. Suppose it's gone down from 8% to 2%, meaning you are saving 2% on your interest payments, and remaining months of terms are 248. So your minimum payment amount is going to be coming down to $2,818 from what it used to be $3,501. And then you could be paying, if you're paying 3,500 like plan payment, you're going to be paying extra $600 because your minimum payments are coming down, and current balance remain 400,000. So this is basically your in 248 months, you're going to be finished, paying off all this, your mortgage will be completely paid off, and the total interest payment that you would have paid after refinancing is $298,866 versus what it is to pay $499,062. So you are going to be saving $120,000 on your interest payment as a result of refinancing. I've highlighted in a bold letter in this particular cell in the spreadsheets. And if you would have paid additional amount of as a result of refinancing, you can pay $683, right? If you keep continuing paying $3,500, you'll only be paying, a mortgage interest payment of $194,000 versus $298,000. So you'll be saving overall, interest payment on $161,000, which is basically like this cell C22 minus F22. So this minus this. So you'll be saving $161,000. So I hope you can understand, as a result of refinancing, when you reduce the interest rates or the term roll, we kept it the same, but you could end up saving a lot of money on your interest payments. And in this calculator, it also shows you, say, your minimum current amount. So in this x-axis, tells you how many months it is going to pay off the overall, like this $400,000 mortgages. So usually you would have taken 248 months, so it's going to come down to 217 months with the prepayment. And if you would not have done any with prepayment, you'll pay 171 months, as you would have showed you here. This 248 months, you would have finished it off 170 months. So this is this graph, and this is this cumulative interest payments for this minimum payments and refinanced minimum, or if you do the prepayment refinancing. So you would be saving different amount of money that you could look it up in this spreadsheets. And also here, this is the amortization table. If you have this principal amount, you keep paying the interest, payments remain the same, but that amount of payment is keep going up, and your interest payments is going to be coming down on this column D. So at the end, 248 months, you're going to be paying off this, like the overall mortgages. And here, when you do refinance, with your prepayment, without refinance, 80%, you could have paid it off faster. And with prepayment refinancing at 6%, you would be paying off the mortgage. Even the table, you could look it up. So hopefully you found this information helpful when it makes sense to refinance your mortgage. If you have any question or how much currently you have been paying your mortgages, and if you're looking into appreciate your comment, and if you like this video, please do subscribe it. I take a lot of time to make this video, and I'm not seeing too many subscribers. Hopefully you'll subscribe it and it'll encourage me. I would appreciate it. Thank you and have a nice day.